to the extent the 10-year is at 2.1, the risk-free rate is very low. And if you put that kind of discount rate on long-term cash flows, the market looks pretty attractive. I think it's pretty clear right now the market does believe that the Fed is in the dovish stance. And I think to the extent that dovish stance gets removed, it'd probably be from some kind of economic strength or some kind of positive development on tariffs. So that's where I think investors right now have a little bit of comfort from the Fed.
They can just decide not to do much and still not meet market expectations. I mean, right now, the markets are pricing in a decent chance of a rate hike in July. Bespoke just ran the numbers. If the Fed cuts between now and the end of July, it would be the shortest time frame between two moves in opposite directions since 1995. So, Tim, there seems to be a lot of room for some disappointment if the Fed doesn't come around to the market's thinking right now.
Yeah, and I agree with what Tom said about in terms of the multiple of the S&P. If you believe consensus of 187 for 2020, 2830 on the S&P, you're at 15.5 times, not stretched. But I guess I feel I'm most worried about. I'm not worried as much about the economy or the trade dynamics. I'm worried about positioning, and I look at where bull bear indicators are. I look where the VIX is, and ultimately, at least for the short term, I think those are the biggest dynamics here. I think the bond markets are screaming Fed cuts. I think the Fed, I heard 2 days ago, I may be in the minority on this, but I heard 3 Fed governors, in addition to Powell, say that they see 3.8% unemployment, 3.2% trailing GDP. I realize it's trailing, but that's not a dynamic where the Fed needs to move once, let alone twice, and some people even have 3 times. So I think the market is pricing in the Fed put. There's no question about that, and that explains why everything is muted. But look at negative 23 on 10-year bonds. Look at dollar yen showing risk off. Look at the 10-year Treasury at 210. Maybe that's good news for equities, but I don't like it.
Tom, let me ask you about corporate profits, because if they don't come through, the stock market isn't going to go very far, no matter what the Fed does, no matter what happens on trade. What do you see there? And does that make you more encouraged or more cautious?
Well, actually, I'm encouraged because I think the hurdle is lower. If you look at comparables to last year, as we get to the third and fourth quarter, they're easier beats. But also, if you look at the underlying economy, the consumer is still really strong. So there's some strong economic backdrop to strength. Obviously, tariffs and fear of tariffs put a little bit of a damper on activity, but I think that puts more of a damper on longer-term activity in terms of CFOs planning CapEx, more so than Main Street planning their daily spending.